I'm back with another part in our breakdown on the One Big Beautiful Bill series, and today we are talking about the no tax on tips and no tax on overtime section of the bill. Beginning in 2025, new tax provisions included in the One Big Beautiful Bill will allow certain employees and self-employed individuals to deduct qualified tips and overtime pay from their federal taxable income. These deductions will be in effect through 2028 and are subject to specific rules, eligibility requirements, and reporting obligations. For tips, individuals may deduct up to $25,000 annually in qualified tips. This applies to cash or charge tips received directly from customers or through tip sharing, as long as they are reported on a W-2, 1099, or Form 4137. To qualify, the individual must work in an occupation the IRS determines as customarily and regularly receiving tips. As of December 31st, 2024, the IRS is required to publish this list by October 2nd, 2025. So while we don't currently have the list, come October, I will have it to you as soon as we get it. The deduction is available to both itemized and non-itemized taxpayers. It phases out for individuals with modified adjusted gross income over $150,000 or $300,000 for joint filers. Taxpayers must include their Social Security number on the return and file jointly if married. There's an important limitation to keep in mind when it comes to the new deduction for tips and overtime under the One Big Beautiful Bill. While many self-employed individuals will qualify, not everyone is eligible, specifically those working in what's known as a specified service trade or business, as defined under Section 199A of the tax code, are excluded. This category generally includes professions where the value of the business is tied to the skill or reputation of the individual providing the service. For example, a self-employed accountant, attorney, or professional financial advisor would fall under this exclusion. The same goes for professionals in the performing arts, athletes, and even certain consultants, especially in cases where clients are hiring you specifically for your expertise or professional reputation. It's worth noting that this exclusion does not depend on whether tips or overtime are part of your income. It's about the nature of the business itself. So, even if you receive tips in one of these roles, the deduction may still be off limits under the law. The IRS will likely issue additional guidance to clarify how this rule applies in more complex or overlapping situations. But for now, individuals working in service-based businesses tied directly to their professional reputation or professional credentialing should assume they are not eligible for these new deductions. As always, if you're unsure whether your self-employed work qualifies, it's a good idea to consult with a tax professional once final guidance is released. And Phil also creates a separate deduction for qualified overtime pay. Individuals who receive overtime compensation required under the Fair Labor Standards Act can deduct the portion of pay that exceeds their regularly hourly rate, typically the additional half-time premium. For example, if the regular rate is $10 per hour and the overtime rate is $15, only the $5 premium is deductible. This deduction has an annual cap at $12,500 for individuals and $25,000 for joint filers. The same income threshold and filing requirement apply as with the tip deduction. Only federally required overtime under the Fair Labor Standards Act qualifies. Overtime required by state law, collective bargaining agreements, or additional pay for holidays or shift differences is not eligible. For example, the legislation includes new W-2 reporting requirements. Employers must report the amount of qualified overtime compensation and identify cash tips along with the employee's occupation. For tax years 2025, employers may estimate these amounts using any reasonable method specified by the IRS under the Transition Relief Rule. The IRS has indicated that further guidance will be provided These new deductions affect income tax calculations, but do not alter new employers reporting wages for Social Security, Medicare, or most 401k plans. Income tax withholding procedures may be updated by the IRS to reflect these changes, and employers will be responsible for implementing these once issued. The new provisions may reduce taxable income for eligible individuals while introducing additional compliance and reporting requirements for employers and payers. We will be sure to keep you updated as the IRS rolls out their guidance for compliance.